Hey everyone, welcome to The Raise. Today we've got the pleasure of speaking with Mark Clare, the founding partner of Clare Capital, who provides corporate finance advice around mergers, acquisitions, divestments, corporate finance advisory, and of course capital raising as well. Mark's got a wealth of experience in tech and capital markets. He's got many notable clients. To name a few would be Xero, Hatch, Raygun, and Sin7. And we're excited to delve into his insights today on what B2B SaaS companies need to know about all things M&A and capital raising as well. So, Mark, thanks for joining us today. I really appreciate your time.
Ryan, what pleasure to be here.
Well, let's just crack into it. I know you've sent me a really great background on yourself. It was great to learn all about your story. Do you want to just generally summarize what is your background and why have you ended up doing what you're doing today?
Very happy to do that. As you noted, I run a boutique investment bank here in Wellington called Clare Capital. We provide, as you noted, a range of corporate finance services to predominantly tech companies, but other ones as well. And that covers, as you say, mergers and acquisitions, various advisory and capital raising. My background is originally worked in finance and accounting roles before spending some time in London working for the likes of Citigroup before returning here to New Zealand and joining the investment bank Cameron Partners before going out on my own nearly 20 years ago. And the current version of Clare Capital was established 11 years ago. And what I would say around a bunch of that is I could see a lot of the tech side of things was beginning to take off. Xero had IPO'd 3 or 4 years earlier and was starting its sort of run up. We could see that the future was going to be online and that New Zealand software businesses were starting to become real and credible. So we were lucky in our timing, but we also brought some strong corporate finance to the market. And it was a combination of some good timing, plus some hard work and some smarts from us, which have got us where we are today. And as you say, we've worked with a range of the New Zealand tech companies over this last 10 years, from those sort of larger players such as the Pushpay, Sin7, Xeros of this world, but really our sweet spots working and helping sort of entrepreneurial businesses either to raise money, to think about what the future options look like, or when the time is right to look at some of those exit options.
Yeah, sure. Some fantastic experience. Absolutely, and that's great. As you said, I think success really looks like a range of great decisions. Obviously, the experience to back it up and execute, and then timing is another piece of that as well. And I think it sounds like you've just at the right time just really identified this opportunity and made the most of it, which is awesome. We were just chatting offline before around some of the state of capital raising and M&A. Really keen to visit that again. Like, what's your view on the current state of capital raising, the capital raising market in New Zealand?
Yeah, look, it's sort of the Mark Clare and Clare Capital perspective on it is for the right type of company, we are not short of capital here in New Zealand. The biggest challenge we've seen from in dealing with a lot of companies is they don't actually understand what the VCs and private equity players are looking for in a company that they can credibly put an amount of capital into. It has been a harder period of time over the last 2 years, both in capital raising and in mergers and acquisitions activity generally. What we've seen is as things have got tougher and more challenging, the capital providers have tended to focus and provide expansion capital to their portfolio companies that have been doing well, and they've been triaging some of those that haven't been doing as well. And for anything new to come on board has required it to be, something reasonably compelling and a business with a demonstrable level of traction and a compelling proposition around it. That being said, we're seeing that free up more, and we're certainly starting to see both international and domestic capital providers, looking again, for opportunities and for companies at a greater level than they probably have done over the last 18 months to 2 years in that capital raising space.
Yeah, it's certainly not 2021 anymore, where it felt pretty easy to raise capital. Obviously, have to put in the work and show some of those milestones as well, but certainly there's a lot more scrutiny around who gets invested in and also who doesn't get invested in as well. You touched on that there is capital available for the right company. What does the right type of B2B SaaS company look like? We flag 4 things that we think VCs and acquirers are looking for. So the first of which is a large total addressable market, and ideally that's a vertical play. If you provide project management software to every law firm around the planet, that's a very compelling offering. But if you provide general project management software across a range of industries, that's not quite as compelling. Both have got decent sized markets, but people really want that vertical total addressable market. So that's one. The second thing that investors and acquirers are looking for is a level of scale in revenues. So the comment we would say is people want, as you know, 2020, 2021, they were looking for greater than $1 million worth of annualized recurring revenue. It's probably more like $2 million now to get you onto the radar screen of anyone. If you can get if you've got over $5 million worth of annualized recurring revenue, you've got a range of options. And above 10 million, you've got a range of international options to be able to to look at those. So those 2 pieces are key. The third element is the underlying unit economics of the business. Now, when we helped the likes of Pushpay, when they went through their IPO process and their initial stages as a listed company, people focused very much only on that, recurring revenue number. But now absolutely everybody is diving down into the details and wanting to understand what those underlying unit economics look like. Everyone wants to dive into those cohorts and understand what that looks like, what does churn look like. But also you need to show that you've got a real software business. So a classic case of that, you need to show gross margins greater than 80% for a SaaS business there. So if you've got a vertical large market, you've got a level of revenue scale, and you've got the underlying unit economics, yes, you're compelling. But how big your revenue multiple, or with those 3 parts that you've got, you've earned the right to be valued on a revenue multiple basis, and how big that revenue multiple is will be driven by how fast you're growing. And that's probably a key thing around it, where there's quite a drop off in growth rates. So if you're growing greater than 100% year on year, you're looking at that 8 to 10 times plus ARR type number, but it drops off quite dramatically. If you're only growing at sort of 20, 25%, you're far more likely to be down in that sort of 1/4 times ARR range. So it's those 4 key components that we would say that you're looking for: large total addressable market, ideally a vertical, level of revenue scale, good underlying unit economics, and growth. Yeah, nice. I love the method that you have to approach that. It makes tons of sense. You talked about 80% gross margins as being one of the things that's just a high-level indicator of a viable software business. Do you have any other sort of unit economics targets as well, like general CAC benchmarks or churn, for example? The comment that I would say around that is, and one of the things you'll hear me say a bunch of times with this is, it depends. And, when you get into some of those underlying unit economics,
components there. It really does depend on the industry that you're in on some of those ones. And again, there is quite a lot of, compared to when we were doing this, and starting to put some of the work together and helping the likes of the Sequence and that of this world, there really weren't a number of the rules there for different industries. But it really does depend. And every time I sort of throw out a number for some of these ones around it, it will be wrong for some industry, and somebody will reach out and go, you haven't got some of the pieces there. One of the things that I would flag on some of this, which again comes back to that, what's the market look like at the moment for capital raising and for M&A, under the underlying unit economics sort of headline, that does include sort of cash flow and profitability. And it absolutely has been an element where we're seeing a far greater focus on that, getting close to break even, that ability to show a path to profitability around it. And the one thing we would definitely say at the moment continues to be companies being able to tell a story where they can get to a cash flow break even in the near term is probably one of the key underlying things across all of those businesses at the moment, compared to the days of people being very happy to fund losses and fund growth.
Yeah, no, that totally makes sense. That there's a lot of variability as well, and the break-even cash flow aspect also makes tons of sense. When companies do get close to break-even or do get to break-even, in your experience at the moment, are people tending to then raise capital and go back into funding losses, or trying to sort of maintain that level and just grow more efficiently?
It's the latter, trying to grow more efficiently. I do think this period, this most recent period, has certainly, maybe not scarred people, but has taught a range of lessons about the importance of efficient growth and doing things the right way. We will always drop back to stages where there will be, growth. Growth will become the absolute focus, and it's starting to come back there. But one of the things we're certainly seeing is a continuation of people, looking very much at how much cash is being burnt and how efficiently they're utilizing capital that they have.
Yeah, no, that makes sense. And one of the things, I think it's pretty a commonly held view that SaaS companies to grow should lose money, or certainly it has been that. Obviously now we're moving more towards a break even. At what point do you think a SaaS company should just start trying to become really profitable and just taking that capital and using it for other purposes, or essentially just trying to become really profitable, which SaaS companies are great at doing if they want to?
Yeah, and again, I'm going to come back to the it depends component there around it. And look, a big part of that does come down to, again, some of those unit economics of how efficiently you're being able to grow, and what it's costing you to achieve that growth, and and looking at some of those underlying unit economic components there around it. One of the things you rightly say, and one of the comments that we say to a lot of the finance area that struggles to understand how SaaS companies become valuable, one of the comments we say is losses are fine as long as value is being created. Meaning, if you can tell a story where we are going to make losses for a period of time, but we have a business where we can show once we get to a level of traction there, we can turn components of that off and flip over to that growth model, and there will be funding out there for it, as long as you can show that story and that upside is big enough to offset those losses in the near term. And that was certainly one of the things that Rod Drury talked about for years with Xero was, why should I swim to the side of the pool and start going, start looking to generate that cash when I have this big opportunity in front of me. I need to grab as much as that growth and market share that I can, And as we move into that next stage where growth slows, we need to flick that through and start looking at how we move that mix, which is metrics like the Rule of 40, sort of turning around, going, okay, well, where are we at? A Rule of 40 is a good metric to be looking at there, trying to think about where you should be in that side of things. Where if growth does start to decay off, okay, well, we better start looking at how profitable we can be through some of that.
Yeah. And for those that don't know what the Rule of 40 is, are you able to explain that briefly as well, please?
Absolutely. So the Rule of 40, and again, it's moving. There are different ways. There's different versions of the Rule of 40 being moved around at this stage at the moment. But broadly, it is your revenue growth over the last 12 months and your losses, adding those together with your losses. And the answer to that should be, you should be targeting a number that looks like 40%. So revenue growth as a percentage and say EBITDA margin also as a percentage. So if you're growing fast, if you're growing at 100% year on year, you can have a EBITDA negative margin, you can be losing it up to 60% there, and you would still be ticking the box there. But if you're only growing at, say, 10% year on year, you would expect to see broadly a 30% EBITDA margin. Again, so adding the two together to get to that Rule of 40, and 40 being the sort of the target around it.
Yeah, cool. Thanks for clarifying that. And moving on to M&As, what is the current state of the M&A market for B2B SaaS companies in New Zealand at the moment?
Yeah, look, it's, again, a really interesting one. Similar, it's had a similar profile to the capital raising space. Through 2020, 2021, and sort of into the beginning of 2022, it was a very buoyant market, and there were a lot of acquirers out there looking to acquire B2B SaaS businesses, and people were paying attractive multiples for them. It wasn't as crazy as we've seen in some earlier times, but there were a large number of acquirers out there looking to do that. Over the last 18 months to sort of 2 years, it's been quite a bit quieter. There haven't been the same number of acquirers out there looking to complete deals. There certainly have been some players out there, and we've certainly seen multiples and valuations coming back from where they were in that sort of 2020 to 2022 stage. But one of the things we would say over the last probably 2 to 3 months, things have started to flip around again, and we're starting to see a large amount of inbound interest from both corporates and private equity players out of the US and Europe, looking here in New Zealand, looking for B2B SaaS opportunities and companies that are hitting certain metrics and looking in certain industries. Typically, they're looking for, again, companies that are at least $2 million US in ARR, with at that sort of break-even thing with some traction there around it. And again, we're certainly seeing those players come down. The private equity players and a range of the corporates, having sort of hoarded cash for a period of time, all have quite a lot of cash on their balance sheets. And we're certainly seeing them starting to be a lot more active than we have done for the last period of time.
Interesting. And are you finding that sellers and buyers' expectations are a little bit mismatched, or is that leveling out as well? I'm just thinking about the context of, 2.5 years ago, most people were raising capital sort of 7 to 10x. Now, as you have touched on, depending on your growth rate, you might be raising capital at like a 1 to 4x if you're not growing particularly fast. What are the sort of difference in buyer and seller expectations at the moment?
Look, there is certainly still some of the hangover from that time of, I have a B2B SaaS business, so somebody's going to pay me 10 times ARR on it no matter what. And even this week, we've had one client who's had somebody reach out, and there is a slight mismatch because the founders, shareholders still have a little bit of that historic view where the other parties are coming in with sort of more in that sort of 4 to 6 range rather than the 7 or 8 plus times sort of ranges around it. So we are seeing a bit of that. But the general comment I would say is most of the founders, boards of directors, shareholders are reasonably across where multiples are at the moment. And again, high quality companies are finding high quality exits. And again, I fully expect we're going to see maybe not quite as bullish as it was, but we are certainly seeing parties out there in the market at the moment doing some of that.
And interesting. And what about sort of exit as a last resort? I'm aware of a few companies in New Zealand that have worked really hard to grow, but have really found it hard in the last couple of years. Are you seeing many sort of exits as a last resort where maybe they're just sort of selling their assets or their IP or parts of their product and that type of thing?
Yeah, look, today Lay-By's just announced its sale to Klarna out of Sweden, which is very much a case of that. The answer is yes, we have seen some of that. What we are seeing on that, again, a couple of years ago, companies that were struggling, there were options for them, and it may not be. It may have, they still may have been able to achieve, not the 10 times number, but they could achieve potentially that 1 to 2, even if they were under some real challenges. That has flipped around quite a bit. What we are seeing is there are fewer corporates that are wanting to take on board companies that don't have traction, that are potentially losing quite a lot of money. So it's been harder. Some of those parties have found fewer options, and they've probably been valuations and prices of those deals have tended to be more, I'll take it off your hands rather than I'll give you a sort of half to 1 time sort of revenue multiple for it. It's tended to be more, it's almost I'll take it off your hands for $1 type thing around it rather than that. So there's been a bunch of those. We haven't dealt with many of them, but we have certainly seen a couple, and we've been approached about people going, "Hey, we want to find an outcome." But that's been a harder part. And again, I think that reflects where some of the acquirers are at the moment.
Yeah, I guess it's a big part of it. It's just the state of the market and the economy as well. More of a general question, why would a B2B SaaS company go out and seek a buyer? What are the common reasons that you're seeing?
Yeah, one of the standard line and part of the things that we see on some of the bits there, often it's a B2B SaaS company will often receive some inbound interest from someone, and which will often involve them going, okay, we've got some interest there. Maybe we should look at, is it time to look whether there is a higher value owner than the current shareholders? So often it's driven by one party will reach out and look at make an inquiry about acquisition, which will often get people thinking about it. And other times you see a situation where shareholders have potentially been on a journey with the company for a period of time and are looking for some liquidity, and they will turn around and go, it's time to find a new owner for the business. Sometimes it will be management teams that have been going through, have gone through a journey there and are turning around and going, it's time to do something else. The founding management team may have taken a company as far as they can take it and be going, I can see the opportunity here. We'd like to take it. We'd like to find a new owner that can take the business to that next level. So again, there are a range of reasons for that. And there is usually one of those factors doing it. People don't usually tend to turn around and just go, I've hit, a particular level I want to sell. It tends to be, there tends to be a factor and will usually drive why people are looking and wanting to understand what that looks like.
Yeah. Yeah. And I think one of the things we learned about the huge growth in invested venture capital in the, 2020, 2021, is that not every B2B SaaS company can become a unicorn and can exit. And it felt like for a while, that was almost the go-to goal, is that what you should do is just build your company, raise capital, and try to get to $1 billion, when the reality is that's really difficult. There's Xero, PushPay, to name a couple, but there's very few companies that in New Zealand have been able to achieve that. And even globally, it's actually like a really hard benchmark to hit. No doubt there's really great companies out there, and I think there's several at the moment that will end up hitting that valuation. But no doubt at the moment, people are starting to think about what they want to do with their companies differently. Do they want to just build a company and make a profitable company that can earn them a living, or do they want to actually build it to sell it? What sort of decisions do you think, what kind of decisions are affected at the early stage when founders have set an exit as their goal or a capital raise as their goal?
Look, the comment I would say there around is, and you are right, there are different entrepreneurs with different focuses and where they want to go with it. And we've always had massive respect for what Rod Drury and the team did with Xero, where they went, had M&A options, but went, no, we want to go down that IPO route and take it to that bigger level. Massive respect for doing some of the stuff there. Probably one of the key things we're seeing, and again, which we would view as a key element around that is, you talked about that sort of Series A level and things like that. If you're a founder and you've gone out and you've taken capital, particularly from a professional investor like a VC fund or something like that, you do need to have in the back of your mind, hey, I'm going to have to return this capital to somebody down the track. And, a dividend stream is not what those types of investors are looking for. So they will be looking for an exit, either an M&A exit or potentially an IPO. And, 20 years ago, there was a combination there, but more and more, the IPO option has been pushed to much larger companies, and the M&A route is by far the more common route there. So the comment I would say to you there around is, in thinking about some of the stuff there, it's almost where have you taken that capital from? Now, we've seen a couple of absolutely fabulous companies recently where what we've seen from them is, founders that have been able to bring together, some funding from within their own networks have built it without that professional VC type cash. Now they have a range of options, absolutely a range of options there, and they can do some of the stuff there around it. Frankly, often the financial returns to them are very, very good because, again, once companies get to a certain scale, particularly here in New Zealand, they become attractive to some of those strategic parties. And yeah, the element I would say on those decisions, if you've taken the money, you need to be thinking about it. Now, one of the things we've seen in the mergers and acquisition space over the last, probably 5 to 6 years are some of those buy and hold acquirers come into the market. And what we would be saying to, founders or anyone that's in that B2B SaaS space that are looking at and are being approached by some of those buy and hold players, they're not the ones that are going to provide that really high multiple or that really high valuation. They are interested in buying the business and generating the cash from it, but they're typically not the highest value owner of it. And again, coming back to the thing that we see for some of the B2B SaaS companies, we're often asked, who should we be talking to? We're getting all this inbound interest from some of those buy and hold players. We're like, you can ignore the buy and hold players there. But if a strategic party in your industry reaches out to you, even if it's really early, if it's a big player in your industry, you should have that conversation. Even if it's really, really early, you don't have to complete a deal, but you should engage with them if a strategic party comes in there, because those strategic parties don't appear every day. And if you engage with them, even if you don't complete a deal, you're very much on their radar screen, and you're going to learn a lot of information from them around that engagement and what they're thinking and how that process might play out.
Yeah, wow. It's I certainly, the B2B SaaS company owners that I talk to, it sounds like some of them are getting emails almost daily from PE companies or buy and hold companies or venture capitalists in terms of just overall exits and raising capital and stuff. Often it sounds like it's sort of mass emails that go out and there's no real due diligence being done. So whether it pans out is quite different. But it is a really interesting time for sure. Just coming back to the sort of unicorn status, the $1 billion valuation, understandably, there's been a number of really successful New Zealand companies that have exited for less than that, but still fantastic outcomes for both founders and shareholders alike. Why do you think it's like hard to say no, or what do you think it is that goes through people's heads when they decide to exit for 50 million rather than $1 billion or trying to get to $1 billion?
Look, this is one thing. Again, one of the great things about living in New Zealand is if you exit, and anyone in New Zealand here can have a very, very, very high quality life with $5 or $10 million around it. And when those opportunities come up, people have a tendency to take those opportunities. In the industry, and some of the VCs talk about the sort of the 3 Bs. The founder sells out and buys the BMW, the boat, and batch around it. And here in New Zealand, that has been, people have built high quality businesses. They've sold them not for those ginormous outcomes, but have tended to happy to take the, rather than swing for the rope and try to hit a 6, have been very happy with that single or 1 or 2 runs type thing around it. And my view on that is we're seeing a maturity of the New Zealand software space around it. Rod Drury with Aftermail took his a couple of $1 million outcome there, and then rolled that money from the Aftermail sale with Quest into what became Xero. And one of his other founders didn't. And if you're prepared to take that risk. Now, what I think we're going to start to see is more second and third time entrepreneurs like what Rod did there, where they're going to get that first small win perhaps, and then we're going to start to see them doubling down and showing how big it could be. So I don't think there's anything wrong with the New Zealand market and some of the people taking some of those smaller wins. I think it's how this market develops, how we see capital being recycled, how we see investors and entrepreneurs learning. But as we go through this, as technology in New Zealand continues to evolve and develop, we're going to see more people start to look for those big outcomes. And the comment we say, again, continuing the cricket analogy, is technology in New Zealand, we're in the first morning of the 5-day cricket test. And as we get further into this, I think we're going to see people taking more risk and looking for those really, really outsized outcomes. And again, the Xero story, push pay story tells you that we can achieve that here from New Zealand. And again, I think we will start to see some people go, move away from some of the smaller wins. But I don't think people taking those smaller wins, it's hard to hold that against somebody who's taken the smaller win, which is still absolutely life-changing money around it. I think it's a very natural human thing to do. but yeah, I think as we see the market develop, we'll see more bigger companies being built here in New Zealand.
Yeah, for sure. I mean, it must be hard when you've got, as you're saying, that you can live a really high quality life with like a, on the global spectrum, like fairly small outcome in terms of a sale. And, God knows what I would do if I was in that situation. So power to them. And no doubt it all flows back into the ecosystem in one way, whether that's through advice or investment dollars or new startups as well, new opportunities. When B2B SaaS companies are potentially negotiating a deal, what are some of the common mistakes that you see people making?
Here's the biggest one that New Zealand companies make all the time. They don't realise with an M&A process that if they get approached by a party, that they are in a negotiation, and often they will go, big corporate X came and approached me. I'm only going to talk to company X as part of this process. And they go, well, they approached me, so I owe them some loyalty. No, you don't. So the way that in a negotiation where you get the highest quality outcomes is when you're actually talking to multiple parties that are sort of almost bidding against themselves. A position we talk about, we call competitive tension. The highest quality outcomes are when you have those multiple parties pushing each other, trying to acquire the business. And one of the things, the biggest probably mistake we see with New Zealand companies is they'll have that first approach and they'll have what we call a bilateral one-on-one negotiation with that party, where what they should be doing is going, okay, we've received this strategic inbound interest. Who are the other parties that might be looking at acquiring us? And getting a communication and some materials to those other parties going, hey, we have received a credible inbound response or level of interest from somebody, and trying to engage other parties to bring them into the process is the best thing that New Zealand companies can do around that. And typically you would turn around and go, look, we're taking this seriously. We've hired an advisor to help us through this. Here is some, minimal information, but enough to say, hey, we wouldn't want you to find out that we've gone through a process without telling you that we're doing it. And there's very smart and good ways to deal with that. But that's the best thing that New Zealand entrepreneurs could do. And the biggest mistake we see them doing is going, oh, I'm only going to have this bilateral one-on-one with it. And they'll often come to us and go, oh, look, we're having this one-on-one conversation. How can I, what leverage can I exert on this party? And you're like, the only leverage is to potentially walk away. But the true leverage is if you've got other parties sitting in there bidding against them, that's when you get the really high quality outcomes. So that's probably the biggest singular mistake that we see from New Zealand companies.
Yeah, that makes a lot of sense. And in terms of the due diligence phase, obviously that can be a really big point of contention in terms of the initial offer dropping down from the buyer, or other complications that can get introduced. Is there anything that startups can just do today to be prepared for due diligence, like in advance?
Yeah. So, I mean, first of all, there's a perception out there that as soon as you go into due diligence, the other side's trying to chip away at you. And having advisors, legal and commercial advisors like what we do, you can prevent a lot of that. A lot of the big corporates and the big sophisticated acquirers will work quite hard up front to try and put an offer down where, unless it's something pretty big in due diligence, they're not going to try and sort of chip away at you on some of the stuff there. So there is certainly a perception that happens, but it's not as big a issue that I would say that there's probably a bigger perception that it happens rather than the reality. One of the things that we do say, and for getting ready for due diligence, so the due diligence stuff tends to primarily be focused on sort of the technical due diligence, but also the financial and legal components there and that around it. It's a good thing to have for most B2B SaaS companies is to have a online folder with some key information and keep that sort of somewhat up to date, covering the last 3 years of financials, sort of cohort analysis and key metrics and that there, where once you actually get into a due diligence phase, to have here is some initial information that people can get started with is a good thing to do. We've got a couple of clients where we've given them sort of a initial list of sort of 8 to 10 folders, sort of filling with information that parties will look for, and they've got that prepared. Another really good thing, though, if you're ready for it, and again answering the question of those B2B SaaS companies that you're talking to there that are being inundated with those buy and hold software approaches, is to generate and to have a sort of up-to-date one-page sort of almost level of information which doesn't have anything confidential in it, tells, is a summary of what the business does, how the business model sort of is working there, has some key metrics, and ideally has, even if it's a range of we are at this level of revenue, where if some of those parties come in, they can almost literally just go, hey, I don't want to chat, but here is where we're at. Don't want to get into a huge conversation, but this and that a lot of the time will take a lot of that noise away, because it will allow them to look at them and go, okay, this company's at X, Y, or Z. Okay, I don't need to, it's too small for us to engage with, which is the situation for most of the New Zealand tech businesses. But also having that one-page element there that's written from a sort of almost a CEO level perspective is a good thing for if somebody comes to a company and says, can you tell me about what the business is? If you can put 1 or 2 pages in front of the company which sort of explains what the business is, has an illustration of how you make money, and has some sort of traction metrics showing where the business is operating at, that's an incredibly useful thing for potential acquirers, and that to be able to look at and go, okay, that's fantastic, and then dive down into that next level of detail. Onto the due diligence bit specifically, all of the tech companies we assist going through the due diligence bit are always most concerned about the technical due diligence, but that is hardly ever the problem. The quality of New Zealand SaaS businesses, the tech stuff's brilliant, and it tends to be, the technical due diligence tends to be not as challenging as other parts, and it tends to be more people wanting to get down into levels of financial metrics and having all contracts I's dotted, T's crossed tends to be the more challenging part of those due diligence processes, rather than the technical due diligence, which is the bit, of course, most founders worry about the most, but tends to be the least challenging part of it.
Yeah, that's interesting, and certainly I guess just having good filing and organisation and thinking through some of the contracts you do agree to probably does impact some negotiations quite a bit, depending on what it is that's in those contracts, right?
Yes, it does. But again, a big part of it is just making sure you're organised. Dot as many I's as you can, cross as many T's. We've worked with companies where, and again, it's probably some of the ones we were surprised by that didn't have their materials as nailed down as much as we would have expected, and we've worked with some pretty small operations or decent sized operations, and we've been amazed by how clean their financials and their level of organisation is fantastic. Both outcomes are fine, but yeah, it is a situation of due diligence is certainly more complicated if everything's pretty messy in the background.
Yeah, and what about employee share schemes? It's very common to give away some equity to your employees as part of retaining them and potentially, offsetting some of the initial lower salaries of an early stage startup. Are there any complications that arise from those types of things in an M&A situation?
No, as long as the scheme has been well put together, that doesn't tend to be a problem at all. one of the things, and you're 100% right, particularly in a lot of the technology acquisitions, the people side of it is absolutely key, and having the right people incentivized in the right way is an incredibly important part of it. So the ESOPs and that tend to be something that just needs to be worked through. Again, when people are setting up ESOPs, strongly recommend working through with the lawyers to make sure that they're all done in the right way. But interestingly, one of the things we have seen over the last couple of years, and we saw this, which became a major thing with one of the deals we worked on, people will want to incentivize key staff, even some that are potentially not covered by an ESOP or are not shareholders. And we've certainly seen situations where founders have had to dip into their own, as part of their own deal proceeds, to provide some sort of bonuses or something, or some retention payments to keep staff on board there. And that's something we can see. But in one of the deals we worked on over the last couple of years, the acquiring entity recognized the value of a group of people and did retention payments on top of the deal value. So again, we're starting to see people be far more sophisticated and recognize the value of those people and design structures to go, how can we make sure that we look after those people around it, which again is a positive sign around a lot of the things there. The key thing we see in M&A processes with staff is people just are uncertain about what it means for them and their jobs when there is that change. And the vast majority of times, the last thing acquirers want for a growing software company is anyone to go anywhere. And the biggest challenge we typically see with that is people, just the uncertainty of an M&A process, and staff going, well, what does that mean? What does that mean for me? And what they will do is that will freak people out far more than, to be honest, nothing's going to change typically nothing will change for a period of time. Now, there are times where people are trying to, extract synergies, which does mean job losses and things like that. But the vast majority of B2B SaaS businesses, the people side of it's vital, and employees, you need to manage that carefully and not bring people into the loop too early. But when people come into the loop, that element of giving as much guidance around what's going to happen as early as possible is key to that post-integration stage and keeping the right people on board.
Yeah, I can imagine that it is quite unsettling when people start hearing about M&A processes as well, for their own job security. On that note, what are the common things you see happen to a company post-acquisition?
Common things that, again, and the best, a lot of our work tends to, when the deal is signed, our engagement will often stop. But, we often are involved in what happens in the planning for that next stage. And to be honest with you, the best acquirers roll in and sit down and produce a 100-day plan for what's going to happen over the next 3 months, 6 months, period of time there around it. And the vast majority of cases, people will not rush to make big changes to start with. They'll literally work, and typically the first 100 days is about integrating some of the back office, particularly financial reporting type activities into the newly acquired company, and having the sort of governance and management meeting components that happen there. And then it tends to be, what can we do to, improve sales and marketing efficiencies and some of the elements like that around it. But the best ones tend to come in with quite a big plan. And typically that plan means not a lot of change to start with, and they make that change happen slowly. But you will quite quickly start to see, financial management changes and people, reporting and getting information back to the acquired company as a starting point like that around it. again, we've seen sophisticated acquirers be very, very understanding of some of these processes. We had one client where they were acquired and they lost a big customer and a good big chunk of their revenues, literally within 2 months, and it was nothing to do with the acquisition. It was just some changes at this particular customer's end. And the founder called me completely freaked out about it. And we sat down and did a call with the company, and the company was completely relaxed. They were like, "This is what happens. It's fine." And within less than 12 months later, they doubled revenues. And the guy was sort of sitting there going, "It's crazy." They were able to bring a level of sophistication and business in. And again, people worry about things which don't necessarily sort of fit there around it. So the big sophisticated acquirers do it all the time. Typically don't change a lot to start with, bring some changes in, and if they're going to make real material changes and integrate things, it tends to happen, further down the track, sort of 9-12 months in before you start seeing anything major.
Yep. Nice. Well, Mark, it's been great to chat to you. I do have one final question for those B2B SaaS companies out there thinking of buying a company themselves, getting acquired, or just need general financial advice. When's the best time to reach out to you?
Look, the conversation I've had this conversation previously that if parties are starting to approach them, the earlier the better tends to work best for getting the most value out of an advisor. The conversation or the point we always say is we'll always have a free, no obligation chat to somebody. If somebody's reached out and a party or a B2B SaaS company is like, "What do we do?" We'll always take that call and give some initial advice around it for free. The comment that I would say to companies out there, if somebody is approaching them, do get advice. You need to find a commercial advisor, an investment banker, and legal advice as well. One of the things we see in New Zealand quite a bit is people going, "Oh, how hard could it be? I'll do it myself." And that, to be honest with you, that's where we typically see real problems start to come in. We would, and again, probably the investment banker would say that, but yeah, even if it's not us, use somebody, you find an advisor, you won't regret that decision to do that. But the earlier, the better. If the further you go down with engagement and signing term sheets, non-binding indicative offers and the like, the less help that you can actually get there and around it. So you want to bring people in as early as possible. But yeah, if you get into some stages and you're stuck, don't be afraid to reach out either to the likes of ourselves or some people in the legal community.
Nice. Well, it's been great to chat to you, Mark, and thanks for your time.
Mate, Ryan, always a pleasure, mate. Thank you.